Welcome back, everybody. Welcome, welcome. Really appreciate it. Thanks for being here for the Minds of Market podcast. And what we do with this thing, we try and take a real deep dive into the minds of some of the very best people in this industry out there, traders, investors, whatever it might be, because our goal is to help all of you learn from some of the very best that are out there and improve your knowledge and your skill set as a trader or investor. And I can think of no one better, especially with what's going on in the marketplace right now, than our guest today. And our guest today is Steve Sosnick. And I'm going to do a brief bio. I could probably take up the whole time actually reading his bio here, but we're going to do it real briefly. Steve is the chief strategist at Interactive Brokers, head trader at IBKR Security Services, and his expertise, and I know this firsthand, extends from algorithmic to electronic trading strategies. And he's been in this business since way back with Timber Hill. Timber Hill I don't know if they were formed as a trading company, but when I traded on the floor, Timber Hill was a big presence on the trading floor. Steve is a very respected voice in financial media. I mean, it's pretty hard pressed to go one day without seeing Steve on one of the major networks. And actually, Steve, I'm going to get into it. That's where you and I first met. It's got to be 5 years ago or so. We both sat on a panel together at Yahoo Finance, and that was great. So you can see Steve everywhere on the major networks. He holds an MBA and a BS in economics, and we sometimes know what that BS is. I have one of those too. His is, though, from the Wharton School, University of Pennsylvania, and he currently serves on the board of MIAX Pearl. Is that correct?
The MIAX Pearl, yeah, one of the 17 options exchanges out there now.
Yeah. Perfect. So, this guy right here, folks, you have to follow him. You have to listen to what he has to say because there's never any BS to it, and he knows these markets backwards and forward. So let's kind of start at the beginning here. Again, I had no idea who you are or who you were, quite honestly, and I was doing a guest appearance in New York on the desk at Yahoo Finance, and we were on a panel together. I remember it was Julie Hyman was interviewing us. I don't remember what we were talking about, but here's this other guru out there on the panel with me, Steve Sosnick. I'm like, okay, great. And then after it was over, I left. I looked him up. I'm like, wow, that was big guy that I was sitting there with. So that was pretty cool. And ever since then, we've gotten friendlier and collaborate a little bit together. I want to know, how did you get in this business, though? You went to grad school, and I know when I went to University of Illinois, it's not Wharton. I went to University of Illinois. I got my bachelor's in finance, but I had no clue what I wanted to do with it. And through a freak of nature, I got into the trading world. That's a story for a different time. But how did you get into this world?
Well, I mean, it's funny. First of all, that was a hell of an introduction. I got to just bring you around with me and do the introductions wherever I go, because that's just too good. And just if I could go on the Yahoo story one time, what happened was I was originally, and you did this too, we're doing some of those options insight segments with Julie Hyman when she was on Bloomberg.
Yep.
And what happened was I started doing them, and we were very much under the radar. That was very deliberate. Prop trading shop. You didn't want anything. Timber Hill was how Thomas Petterfee started his Amex market making business. In the 70s basically.
Right.
But anyway, what happened was, and I think I've told you the story. So I start watching that segment pretty religiously because I figure if I'm going to be on, I got to hear what everybody else says. One of the guys who used to be in the pit with you said, you came on, he said, I don't like that guy. I'm like, why? He seems like a really nice guy. And he said, no, he bothered me because we had those handheld machines, but he could always price complex spreads faster than I could. So
They
that was by way of introduction to you. He's like,
That's
so I'm
great.
like, so it's not, so you're not saying he's a bad guy. You're just envious. He said, oh, absolutely. So that was, so
And
that,
Timber Hill did. They were widely known for having the handheld machines before we had handheld machines. When we
yeah.
used to trade just with cards and paper, yeah, there was no doubt about it. And those of us that didn't have that, we frowned upon that. We were jealous, but we frowned upon it. So that's really funny.
But you're known for having outsmarted the machine. So how did I? It's or at least being quicker. And so anyway, so how I got into it was, growing up on Long Island, my dad was at a Wall Street firm called LF Rothschild back in the day. No longer exists. Kind of blew up in the 1987 crash. Not from his fault, but some bad risk arb bets. But anyway, I was a summer intern there in the 80s. And my dad was in the research department, so that was where I worked initially. But I started working for one of the technical analysts at the time, which was essentially like working for like a voodoo priest or something like that. Was how it was, was how it was viewed. But I got to go up on the trading floor all the time, and I ended up more or less converting my internship to sitting on the over-the-counter trading desk, which in those days in the 80s, over the Nasdaq marketplace was just nuts. I mean, it
Yeah.
was just people. It was insane, and I loved it. I just like, oh my gosh, this is what I want to do. Um, and so when I was graduating, I guess when I was getting the between the years of my MBA studies, I got a summer internship at Solomon Brothers in sales and trading, which was kind of, I got to admit that was a pretty cool thing. I can't believe
That was a big deal.
I still can't believe I got it.
Yeah.
Actually, as I was leaving that summer, Michael Lewis was arriving.
Okay.
Was the timing for those of you who've ever read the book Liar's Poker.
Yes.
Um,
I have
so
that.
and I loved it. I thrived in that environment. Went back to work from after I graduated, pretty much just in time for for the 1987 crash. And then the rest was history. I fell in love with it, and a couple twists and turns, and I ended up at what was then this little options well, not so little, but this options market making shop with this relatively strange guy who figured out that if I gave all these people handheld computers and centrally priced everything and centrally hedged everything, we could maybe make a go of this. And that along the way, we once electronic trading was coming around, we bought pretty much the same time I arrived, which would have been 1995-ish. We bought a small German web-based broker called Interactive Brokers. But as time evolved, we realized it was kind of silly to have the firm to have the to have the firm called something that was essentially a proprietary trading firm that wanted
Right.
to be hidden, when we had this customer facing business which we wanted to get well known. And so the firm became, Timber Hill became Interactive Brokers.
So were
But
you
that's
on the floor at the New York Stock Exchange or where were you on the floor for
I
Tim?
was rarely ever on the floor,
Okay.
actually. What happened was when I was at Solomon Brothers, you had part of the training program, especially once you made the decision to go into equities. And that was a very fortuitous thing because I was really slated to go into government bonds, which was the place to go. But I just didn't. There was something about the guy I was going to be working for that didn't jibe right, and I didn't take the job. And he ended up going to prison actually for trying to fix government bond
Yes.
auctions. So
That was a
that
pretty
was a
good
pretty good miss, I think. Sometimes the best trades are the ones you don't make. And I thought the guys in the equity flow were just fun, and it was a ripping bull market, and the bond guy, and it was a big bear market in bonds. They were all miserable all the time. So I'm like, I want to work with these guys. But so yeah, I did have to spend a couple of months basically chasing people around on the floor, and work and being in. I've specialized in foreign stocks, and so that meant I had a very wide mandate because in those days you were either a New York Stock Exchange trader, where you phoned in your order upstairs, you'd phone your orders down to the floor, or you traded Nasdaq over the counter upstairs because there were very different ways of trading. Except if you specialized in ADRs, where you had to do both. And that's what I did. So I specialized in
right?
ADRs, Canadian stocks, which are technically not ADRs. Um, and I ended up getting into warrants for the same reason. And being on in that group, I was the one with the most quantitative background, so I could
Yeah.
handle the option stuff, and eventually gravitated toward that end of the business. I did some stints, and I did a stint afterwards my department got poached from Solomon Brothers. We went to Lehman Brothers, or Shearson Lehman, American
Yep.
Express, Hutton, whatever the hell they called the place. Change every 6 months, which was a mistake. But I ended up trading like Nikkei warrants. Fun story about that one. We there the over the counter department and the listed department didn't speak to each other, and so both sides hated us because we traded both and
Yeah.
sort of didn't. And you know, there was one day, there was sometime, probably it must have been 1990 or something, or when the markets were just getting crap. They were just getting the crap kicked out of them, and it must have been around the first Gulf War or something like that. And the guy who ran over the counter, I'll leave his name out of it, but he was kind of a legendary character in the over the counter crime family business. He said, I don't want anybody with long positions anymore, anywhere on this floor. No net long positions. Get yourself as flat as you can, which is kind of a practical impossibility. But
Yeah.
so what I did was I realized we weren't going to be able to do that with the over the, with our positions, especially being around the world. You couldn't necessarily get out of them. So I went heavily long Nikkei warrants to hedge the desk's position. And
Okay.
he's going around the room the next day. The market was getting the crap kicked out of it the next morning. So he was right in that regard. He had very good market sense.
My guess is he didn't understand what you did, though.
Bingo. So what happened was he's going around the room looking at at positions, and he sees that I've got this huge long position.
And he's like,
exactly. He's screaming like, "What the hell are you doing? How much money are you losing?" I think I'm up a few $100,000 right now. And he's like, "What?" And I said, I got to do the, things are moving really quick, but I really, are you telling me that you have some magic product that goes up when the market goes down? That's exactly what I'm telling you. Except it's not magic. This is what it's just. Finally, he's like, how much? I'm like, if you just let me close out the trades, you'll see that this was an exceptionally profitable day. So as a result of that, I ended up trading what was then called primes and scores, which then became illegal because it was essentially they figured out it was essentially like a listed buy right, and so there was there were tax dodge, as it turns out, and it was a horrible thing, and the place was mismanaged. And I went to Morgan Stanley, and then got the opportunity from Timber Hill, and I said maybe I should be at a small entrepreneurial firm rather than a big one. But that's a long-winded way. And then I became, but even then, I was, as the guy with a lot of upstairs trading and risk management experience, that's what I was designed to do, because we were getting into equities trading. We were primarily an index trading firm, but we got into individual equities, but didn't have anyone who really understood, the stock market end of it, the equity trading aspect.
The relationship also,
because once you when you're trading indices, as is the market going up or down, or is of course there's always the vol component if you're trading volatility on it, but in terms of you don't have as many idiosyncratic risks to hedge. If you're trading an equity portfolio, around earnings, dividends, there's all kinds of extra risks that you involved, a whole multitude of them.
Yep.
And so they didn't have anybody who had any experience managing those risks on a large scale.
So you created your own position.
Yeah, pretty much. I literally made up my first title, which was equity risk manager. Like Pettit was like, "Oh, that's a good one." And I made up the chief option strategist title when I started talking, when I was given the ability to start speaking publicly. And once I was able to talk about more than options, I made up the chief strategist title, and no one's complained yet. So here we go.
So you're one of the you're one of the, and I will say this whether it's bravado or not. You're one of the very few people in this industry that really never traded on a floor, that knows the business inside and out and knows the floor business, because trading on the floor and what happened there and the relationship, the dynamic between the markets is way different than just learning it on the screens. But you get it. You understand it. And I know that because, again, backing up a few minutes here, going back to our days of being interviewed with Julie back on Bloomberg, when we talk about the VIX, talk about what was happening, you had this insight as if you were in the pits, as if you were a trader in there. And I'll be honest, you don't see that very often out there.
Well, I will say that having been an OTC market maker upstairs, it was the equivalent of being in the pits. It just wasn't. It just wasn't. The way the Nasdaq was structured, you had to call people on the phone. You had to have relationships around the street. If you wanted to buy 10,000 shares of whatever, Nokia in those days was a big name. If you wanted to buy 10,000 shares of Nokia, there might be three guys on the offer. Well, am I going to call the guy at Merrill Lynch? Am I going to call the guy at Goldman Sachs? You know what? The guy at Merrill's pretty. He's a decent guy and a straight shooter. He's not going to front run me. Whereas the third guy on the offer is like some fly by night firm, and I know that if I call him, he's going to turn around and try to buy it in my
He's going to
face.
be good ahead of me.
Exactly. I'll end up like all the offers will be gone, and I'll find that he front ran it. So that mentality it's a very similar mentality to the floor. It just was not, the physical setup was different, but the mentality was the same. So I always did come to it with a floor mentality. And I was always comfortable on the floors. I would visit the floors a lot. The only time it became a bit uncomfortable was when the people on the SIBO realized that I was coming a little too often, and that was when the hybrid system was being developed. And
they knew something was
they knew something was up.
Askew.
Yeah, they knew something was up.
Yeah.
And that was not the most comfortable. But and I've always had immense respect and immense fun for the floors, and that was a little uncomfortable. But truthfully, we all knew that was coming. You were smart enough to know how to adapt. A lot of other guys a lot of the other guys you see around were smart enough to adapt. Unfortunately, a lot of others were not.
Yeah, I would say
but that's the way the business went.
The majority of the people, it was very difficult to adapt. There's no question about it. I count myself very, very lucky and fortunate that, that did happen for me, because I know a lot of the people that I traded with, a lot of close friends of mine, just couldn't do it. And, that was kind of the end of their trading business, if you will. Yeah. Speaking of being on the floor and coming to the SIBO, have you been to, and you can see the S&P 500 pit behind me, have you been to the new floor in Chicago?
I have not. Last time I was on the floor was certainly pre-COVID. I mean, okay. I've been to Chicago since, but and I know you and I missed each other last time I came through last summer, but I've not been to the floor. I'll have to do that on a next trip through.
Happy to take you
down. It's pretty vibrant now, I guess. At least the S&P pit.
It really is. And I take a lot of people down to the floor, visitors that come in, clients that come in, and they don't really realize that there still is live active trading. It's not like it used to be, but I take them down onto the floor here, and you're right. The S&P 500 pit is rocking. In fact, often when I'm on an interview, whether it's with Bloomberg or Yahoo or with Liz on Fox Business, I do it from the S&P 500 pit. And there's times, if there's activity going on in the marketplace, that it's difficult to hear the interview. So it is still very vibrant. And that VIX pit that you were a little uncomfortable with, that is still down there as well. And that, gets a lot of activity, but it's still a wonder and an amazement that kind of business can still be transacted in this world of electronic trading.
I think it's great, and I always think there's a place for it, and that's, I think, despite having essentially spent the large part of my career fostering electronic market making and the like, there's always a place for relationships. You can't replace them. You're not going to replace people with AI. There's just something. There's something there that can't be fully replicated. If it was able to be fully replicated, there wouldn't be a need for that. But there clearly is. There's a way to get stuff done. I mean, especially, if I want to, for example, if I want to price a large box or something like that.
Price discovery.
Exact price discovery still works. It's a central place for price discovery. It's very hard to do price discovery on a screen. It's much more efficient in many ways. and yes, I use the word efficient, to do certain kind of trades in a floor environment than it is to just punch in numbers on the screen. For a small trader who's, trading one or two lots here and there, or, a couple hundred shares, or, whatever, screen's sufficient.
You're right. Do your thing there. Right.
Do your thing there. But for certain types of complex trades, or trades that really require, something a little bit extra, the floor, you're not the if the floor was going to be replaced, it would have been so already, and it's
No
not, and
doubt.
there's a reason for that.
No doubt. And you know what? So many traders and a lot of people in the industry said, when electronic trading took over, that's it. Bye bye. But it has worked itself out. And it's actually, I think the volume on the floor, and especially zero DTs have a lot to do with that, but the volume on the floor has actually increased over the last several years rather than, still a little bit on the decline. But well, next time you're in Chicago, I'd love to take you down to the floor, and especially into the VIX pit, and say, yeah, this is the guy.
Done.
Here he
Done,
is.
but I'll come in low key, please.
There we go. So you'd mentioned at the top here that, yeah, there's a lot to talk about with what's going on in the marketplace. And just a couple days ago, I think it was Wednesday of this week, you were on Yahoo Finance. I caught one of your clips, and you were talking about and focusing on what is factoring into everybody being so cautious right now. What is causing this cautious tone in the market? So I'm going to ask you, because I get asked it all the time, and I'm sure you have a much better answer. Is it more the geopolitical risk? Is it the Fed? Is it the fact that we're at all-time highs? Is it that interest rates are remaining higher for longer? Is it a combination of all of the above?
The all of the above answer, and let me expand on that one. The geopolitical is the obvious, right? I mean, obviously you don't want to be in a world where people are shooting at each other, and where nobody really knows how this stuff is going to resolve, and where it's actually in some ways causing tensions at home,
Yeah.
as a result of all this stuff. But you know, the last people I want to ask about how a geopolitical thing is going to resolve itself is a bunch of stock traders. We're not good at it.
No. Just
You
got to
know,
stay in our lane. I learned
stay in
that
our
a
lane.
long time ago.
Right. I mean, so equity investors as a whole are very good at figuring out the things that affect equity prices. How's it going to affect earnings? How's it going to affect revenues? How's it going to affect cash flows? What's going on now is really murky at best. The one group of traders, there's two groups of traders who I think are pretty good at it. Oil traders are really good at it because they live in a world of Middle East tension. That's literally what drives their business. To some extent, commodity traders, depending on what it is they trade and where it is, have some geopolitical knowledge. And treasury bond traders, because of the flight to quality trade, have some sense of it. But that's why I dismiss. I think that the geopolitical stuff is a negative backdrop, but not the reason. I think actually what happened was we had a ridiculous end of the first quarter. And I mean that in a good way, right? It seemed like stocks were never going to go down again, right? I mean, it just, didn't matter, especially if it was anything related to AI, up it went. So we managed to ignore the fact that during the first quarter, oil went from about $70 to $85 a barrel. We also ignored the fact that the 10-year yield went from about 375, 380 to just under about 440 at the time. We went from thinking there might be 6 or 7 rate cuts to, at that point, 2 to 3 rate cuts. We're now, of course, down a little bit, even less than that. And you could say, okay, well, there are some reasons why we could shrug that off, because I think we came into the year with what I thought was a very strange conundrum. Was we were somehow expecting a solid economy and 6 to 7 rate cuts. Those were not both going to happen. You were going to get one or the other. And I've said many times before, if I have to vote, I'm going to vote for the strong economy. We're better off with a strong economy than one that requires 6 to 7 rate cuts. So that's okay. That's good. But then, so then we, I think, got into end of the quarter markup stuff, SMCI going into the S&P 500, all that kind of
Speaking of which,
madness.
right now it is down currently 20% today, almost $200, and it's
Yeah.
it's almost had the natural 2-for-1 split since those
Yes.
highs had put in. It's
Sadly, it got put in like what 1100 or something like that. Now it's about what
yeah,
is it, seven?
traded up to 12-ish or so, and now it's trading under right about 750. So
Yeah, so that's, I mean, that happened. So you
yeah.
had that kind of, so it was natural that we would take a little bit of a breather as the calendar turned. Again, that to me is completely, that's normal, right? You've seen this a million times. You sort of get to an end point. It's like, okay, we're done.
Mm-hmm.
But there wasn't necessarily a positive catalyst. There were some very crowded trades. When you have very crowded trades, it's like a crowded room. If everybody tries to exit them at once, it's hard to. Or if everybody, or if you've got institutional investors who have been, you know, drowning in FOMO, who've all gone long semiconductors and AI stocks into the end of the quarter. Well, if there's a pullback, who's there to buy the dip? And I think actually the trigger was something really benign, and that is the fact that so many people made so much money in 2023. So what happened on Monday? You had to pay taxes on that.
Yep.
So what'd you have to do last week? No later than Wednesday. Well, really, I guess Thursday, but really Wednesday, if you wanted to be safe, you had to start selling some stock
Yep.
to pay. And again, if you've been riding these long positions and you're fully invested, you have to sell. And so I think that was actually in many ways one of the triggers. And I just think that it's just a preponderance of all this. But I think we were so euphoric that this is so that we had sort of an outsized reaction on the way up, that we're having a bit of an outsized reaction on the way down. Another thing that I think may come into play, and I'm still working on this, so depending on when you listen to this, I may be proven completely insane or wrong. I think the fact that you had so many, the short volatility trade became very popular. And you had a lot of money flowing into funds that had volatility overrights, or you
Yeah.
had people just sort of outright saying, "Oh, look, this is free money. If I just sort of sell volatility every month, I can." Well, you and I know that if you sell, there is no free lunch selling
No,
volatility.
no, it's that trade that you see. Okay, I made it, I made a little here, made a little here, and then you get that 10th, 11th, 12th trade that says, "Oh boy," and it wipes
Yeah,
away everything else. There's no
you
question.
you make
Pattern repeats itself.
you make dimes and you lose dollars.
Exactly.
And the key is, the reason why you've succeeded in this business and been successful is you know how to make sure that those dollars are really only 40 cents, or something to that effect. But
Yes.
but I think what happened was, so I do think that sort of I think you sort of have this, like, I hate to say negative gamma trade, because the term gamma squeeze has gotten so misused, but I do think you've had people getting sort of complacent, which is why, another thing about when you sell volatility is, as you know from trading VIX and SPX, you know, okay, so I'm selling it at 14 if I'm selling VIX at 14, where am I going to go? 13, 12 and a
Right.
half,
Right. Well, I
but
think that's
and
what
when it goes up, it's, boom, you're at 18, 19.
Exactly. And I think that's what people got, kind of complacent and suckered into, is once we saw the VIX kind of just trade in this range of 13, 14-ish for a couple months or so, that was the continuation. That was the quote unquote easy trade. And people don't understand that there really isn't an easy trade. And those are the people that I think are, chased it up a little bit and really got hurt. And you have to understand the cycle, and you have to understand, a lot of people don't understand what the VIX really measures. I know we talk about it a lot. I talk about it a lot on TV, that it's a measurement of basically the volatility in the S&P 500 and how much it's going to move. And so when I say to people, if you take that mathematical power of 16 and use VIX at 16, that's basically equivalent to 1% move in the S&P 500, which even when VIX was trading lower than that, 13, 14, the S&Ps were still moving pretty close to that 1%. Something had to come into line. It always
Yeah.
does.
It always,
We don't know exactly when it's going to, but something had to come in line. And what it was VIX finally caught up.
yeah, that's kind of the thing is there's I don't know what the absolute mathematical low limit is to VIX, but at some point, like, first of all, remember you're if you're it's the active traders who drive the bus, as
Mhm.
you know, and so realistically, you're not going to, even if the market moves up and down 1% during the day but closes unchanged, you don't want to use the historical volatility of zero.
Right.
You want to use the historical volatility of the high low,
Mhm.
and so at some point you're not going to outlaw markets from moving completely. Secondly, even if the market is really stable and that the historical volatility is really does annualize to 8 or something, which is a 0.5% a day. Um, at some point, you're not going to sell it at 8. You're not going to sell it down to 8
No,
for the reasons we just discussed. So you're going to sell it at like 11, 12. Now, if you haven't done this very much, you're looking at it. Oh, holy crap! I could sell something at 12 that's worth 8. Well, there's kind of a reason why no one is rushing to sell it down there,
there's
and they
no
know,
question about it. And
and that's why one of my taglines is VIX is not a fear gauge; it just plays one on TV.
I couldn't agree with you more. Every time I tell someone that, the definition you see of VIX is the fear gauge, I do it with those quotes because it
Yeah,
really isn't.
it can act like one, and obviously, yes, it does go up. But to me, VIX really is like the best way. It's the best tool for institutional hedgers still. And people, have zero dated options rendered VIX irrelevant because VIX
Not at
measures,
all.
30. Of course not, because you can't hedge every day. What does that mean? That means that the one day you don't have a position is the day something blows up. No,
Exactly.
you have to use stuff that at least has a 1 month minimum. And or why do I want to hedge? Well, I buy fire insurance. I don't, God forbid I need it. So VIX, so to me, we can get into the mathematics, but if I want to put it in layman's terms, rather than the market's best estimate of the 30-day the volatile implied volatility over the coming 30 days, whatever, I could just hear people turning off the podcast if I were to go into it any further. But realistically, to me, it's indirectly a measure of the demand for institutions to hedge their portfolios. And so when things, during the first quarter and during various points in the last few years, we've had very little demand for institutions to hedge their portfolio. You know what? Nobody's buying umbrellas when you're in a drought. Nobody wants but then the fact that we get these sharp rises means that, oh crap, I need volatility. And that's why when you see VIX futures go into backwardation, that's often, it's not, in 2020 hindsight, it's foolproof. The problem is if it's backwardated, it could get more backwardated, as you and I both know. But that's why, to me, when people say, oh, how do I know when we're kind of near an end?
Well, there's
It's
the
what,
panic. There's the rush to get that near-term protection.
Well, because backwardation, if something is normally in contango, and sorry again if people are turning off there,
No, it's good. We
but
go into it. It's good.
okay, good. So when you see something in backwardation, it generally means that whatever the commodity in question is in short supply, is in, demand exceeds supply in the short term rather than the normal relationship that you
Right.
have. And so when you see VIX go into backwardation, that means that that means that people are clamoring for volatility protection to the point where they're paying above what the market will bear to some extent.
Yeah.
And that to me that's when your real panic arises. That's sort of maybe your moment that, okay, maybe we're getting puked out.
Right. Which that is, again, it's in hindsight, it's 2020, but that is a contrarian indicator. There's no question about it.
And that's why when people say, "Oh, VIX is," and I got asked this question today more than once, VIX is 18, 19. Does this mean we've got maximum panic? I'm like, what, are you kidding?
don't you remember the 35s that we were at, which wasn't really that long ago?
Yeah. And don't you remember that, like, somewhere between 16 and 19 was always considered normal?
Yep. No question about it. We all get trained to be in the moment. But yeah, there's no question about it. So let me ask you another question, then I don't want to take up too much more of your time. Given this heightened sense of caution out there, is there anywhere that's safe, or not even safe? Is there anywhere still right now that is a good play in the marketplace? Can the big boys who are still reporting in the coming weeks, can they save the sell off that we're in right now? And that's probably a bad way of putting it, Steve, because people are saying, "Oh my God, the sell off we're in right now, we're 4%, 5% off the top of the
Exactly.
market, right?" I mean, it's not. But where can we look that month, 3 months, 6 months down the road from here? Nobody's got the crystal ball, but what would you say is, the safety trade, not the flight to safety, but the safety trade?
I think the safer trade, historically, dividends, people sleep on dividends. But I think if you have stocks, and I'm limited in what I can say in terms of recommendations,
Sure.
so I'm not going to be able. But to me, when you're in a rough environment, first of all, no one ever went broke holding dividend stocks. Over time, it's a good thing. I look at some of the stuff. For example, my mother-in-law, who's an extraordinarily astute investor, by the way. This woman lives off of dividend stocks that she bought 30, 40 years
Yeah.
ago. And so as a result, if you have a stock that pays a solid dividend, and very importantly, has the cash flow to maintain that dividend. So not that they're borrowing money to pay fat
Hmm.
dividends, particularly like I'm thinking of private equity sponsored companies where they borrow the money to pay the
Right.
pay the dividends to the sponsors. But I'm talking about like your household name kind of companies, and consumer staples, to some extent consumer discretionaries. Utilities are they're probably a little too bond market oriented, but that kind of idea. If you if you can earn if you can earn enough money to pay a decent rate of return, well, that stock is less likely to fall too far, because at some point somebody's going to a fixed income arbitrageur is going to step in and say, wait a minute, this is better than a bond in some
Yeah.
ways, because so that to me is sort of the safer trade. um you know and in some of the work I've been doing, it's amazing how quickly the trend has turned on shorter term moving averages and stuff. It's like almost it's a pretty steep reversal, actually, in many ways, as almost as steep as the turnaround we had at the beginning of November, which is kind of a little bit worrisome if this does continue. But the
Are you
longer
are you
term,
saying are you saying the trend now, people are not adhering to those shorter term moving averages, or they are more so?
well, I think the short term moving averages have just turned against us
Okay.
violently. The tens and the 10, to some extent the 30. On the other hand, the longer term ones, the 100, 200, are still flat to up. So, very quick rule of thumb, and this is beyond quick and dirty, but you've been around a while. I think you know where I'm about to go. If you're above, if the moving average is pointing up and the stock in question is above the moving average, you probably want to be buying dips. You probably want to be buying the dip, should be your way of thinking. If the moving average is pointing down and the stock in question is below the moving average, you probably want to be selling
On the
rallies.
Ritz, yep.
So right now, on a short term basis, you kind of flip to the sell rally mode as opposed to the buy dip mode. On the longer term basis, you could still make an argument that you want to be buying dips, but that, I think, to me, works better for value investors, longer term investors. And that's why when you're saying where's sort of the safer trade, I keep coming back to, like your big pharma stocks, not
Yeah.
necessarily, that kind of those kind of stocks. And if they do go down, if you do have a drawdown, there's something to be said for earning a few percent, or a few percent annually, because it's what you could do something with that money.
Those, I think, are typically the stocks that in a flat to bearish market are going to outperform, and in a booming market where the high growth stocks are really doing well, you're not going to do as well. So it's that balance there, and I totally agree with that.
Bingo, because someone told me one time, well, you can't eat relative performance. It's great if you have outperformed, but you know what? you can eat off of dividends.
Yes.
So you might get that relative performance. You may look at it go down, but you know what? You can still use that money to do things with it because they're returning money to shareholders.
Awesome. Everybody listening to that. Again, Steve Sosnick at Interactive Brokers. Find him on any of the major news networks. Just look him up. Read his pieces that he puts out there. He is not only one of the most respected in our industry. He knows what he's talking about. He makes sense, and it's someone that you want to follow. So I look up to you in for the media portion of what we do, and for people following and really looking at our analysis. I look up to you so much because you are so respected and so spot on, and everything that you say makes sense. We all know that every decision we make is never going to work out 100%, but the rationale for making those decisions, that's the key, and you are always spot on.
Well, thank you. I'm proud and honored to be joining you on this podcast, Scott. As I said, you know that you're one of the voices I respect. So it
Thank you.
flows both ways, and I really enjoyed this discussion. I can't believe how quickly it went. So.
I know, right? There we are. Here we are. So, all right. Well, thanks again, Steve. I really appreciate your time.
My pleasure, and we'll talk again soon, Scott. Take care.
You got it.
The Minds of Markets podcast is an exploration, a deep dive into the minds of some of the best traders and investors in the market. Our goal is to help you, the listener, learn from some of the best out there to improve your knowledge and skill set as a trader or investor. The Minds of Markets podcast should be used for information and entertainment purposes only. The opinions expressed in this podcast are our opinions only, and none of the information contained in this podcast constitutes a recommendation that any particular security, portfolio of security, transaction, or investment strategy is suitable for any specific person. Trading is risky, and past performance is not a guarantee of future results.